right, so here is the dollar index, and it's an hourly chart. And I mentioned last night, I said I'd like to see the dollar index just keep on going higher, not try to, pull any kind of retracements whatsoever, just go higher. And we got that. Now, I don't want you listening to me today thinking that I'm patting myself on the back, because I want you to remember what I said yesterday and what I've been saying leading up into today. Non-farm payroll weeks are going to be weeks where I am generally wrong on Thursday and Friday of that particular week. Now, if I know I'm comfortable prior to Wednesday at 7 o'clock in the morning taking a trade or outlining or framing a trade, let's say it that way, then okay, then I'll operate in that area. But I won't operate after Wednesday's New York Open. And as I said last night, the idea of missing a move, I don't care. Because I know this stuff repeats over and over again. And when you see stuff like this, especially as a new student, or you see a move in like Euro today or cable, and you think, wow, I missed that move. You need to log that today. Anything that you feel emotionally or psychologically about seeing a move today, record how you feel about it. And be honest, but you're not trying to do this on a daily, okay? But this one time, put everything that you can describe emotionally and psychologically about what you may be feeling about this, okay? Because you want to be honest with one reference in your journal where you're being brutally honest. Like, use the descriptors that you would normally say. Like, I feel stupid that I didn't see this, okay? Instead of saying something like that, say, I really wish I would have seen this. See the difference there? You're not kicking dirt in your face, but you are acknowledging that you feel a certain way about not being a part of this move in shorting Euro or shorting the British pound or whatever other currency pair that you may have used. That is important because it'll give you a baseline. And then going forward, you won't feel these impulses to be complaining about maybe not participating in a move like that, because there's other days that present things that are more probable, and you're going to just keep doing those types of setups and just leave these types of setups to whoever else, because this could have happened the other direction, and I could have been wrong where I said I want to see it go up and just keep on going higher, run out this high here, and run into, scrub this up a little bit, this imbalance over here. Okay. All right. So if we were sticking to what I was saying last night, I want to see the dollar go where it's traded to here. How do we know how far it can go? Well, this is your hourly chart, and we have a swing here. Okay. We have this low to this high. I'm going to show you the fib, and I'm using the bodies of the candles here. Now, this is one of those questions you get all the time when you watch certain videos, and you'll say, why is he putting it on the fib, and why is he putting it on the body here? Why isn't he consistently staying on the fib on the body or the fib on the wick? I want you to look at this price leg here. Okay. At the high of this, all of this wick here and all of the tails here, all of that is reaching for liquidity. And because I know that is the case, how do I know that? Well, first of all, it's a major turn in this time frame or intermediate term. So this turn and this turn down here, I know at the tails and the wicks, the brokers are going to do their business there. This and this, where the bodies are, that's where my focus is. So I know that's the bulk of the volume. So I'm going to trust those measurements to get the intermediate term price legs. So if we look at this here, we have an objective here and we have an objective here above this high. So this is the closest one. So 91.63 and 6. And we get real close to that in here. Now, if I use the wicks, this is the problem with doing this. If you use the furthest extremes, you're going to hold for a target like that, and it might not come. Now, it might happen tomorrow. It might happen, on Sunday or Monday. But you're not going to be comfortable holding the majority of your position if you're going to take a partial off here. I knew this by experience, and you'll know it by experience when you start doing it. So what I do is I want to look for the most realistic objective using the bulk of the volume. When I say the bulk of the volume in this move here, it's encapsulated in the bodies. I'm not using the highest extreme high and the lowest extreme low, because this is going to be stop runs at the broker level. And there's no way to determine, because if you look at a data feed for several different brokers and you compare their highs and their lows at the same reference points, they're never going to agree in Forex. They're just not going to agree. Whereas if you look at like a futures market, everybody has the same futures price because it's coming from the Chicago Board of Trade, CBOT, or it's coming from the CME, Chicago Mercantile Exchange. So you're getting their fee. That they're basically the central bank, okay? And they have rules and things they have to go by. In this market, in Forex, there's a lot of leeway for the broker to fluff up the spread. And that is always going to be the case in the wick and the tail. So I want to use the bulk of the volume here with the bodies and try to get my measurements there, because I'm more likely to get that than if I use the furthest extreme. And I'm not saying that you can't find these levels where it goes from the highest high and the lowest low and use your fib projections for that. Then yeah, okay, great. But I'm not personally going to hold for that. So I'm not using this for determining the equilibrium or discount to premium. Notice that. Okay, this is one of those moments where you should be writing this down. Okay, when I'm using the dealing range for determining equilibrium for premium to discount or discount to premium, I would factor in the high and the low, and wherever that equilibrium is, then it is what it is. That's the difference for using wicks and candles. And as it relates to order blocks, that's another discussion, and I actually talk about that in several places in the mentorship, and I'll bring it up again multiple times as we go through this year. Why couldn't you just say it? I know what some of you are thinking. All right, so anyway, the dollar index has been going higher. It ran out the high here. So we know there's likelihood for the bearishness in euro and cable as a result of that. All right, so here is the 5-minute chart on euro dollar. London, high today. Short little retracement ahead of New York. New York's consolidating. Now, why is it consolidating? Why don't you want to take a trade in here? Well, number one, it's non-farm payroll. Two, on the economic calendar, we know at 12:05 Powell is speaking. So here's 12:05, and what's the higher time frame premise? Bearish. So what time frame or kill zone do we focus on getting in sync with that? London close. I didn't teach this on YouTube, folks. Okay, so you charter members that are pressing on me, hey, you owe us a charter member video. Yeah. Look how many videos you're getting every day. This is something I'm teaching right now that I would have held on to for charter level. So market runs the buy side liquidity here, and it's optimal trade entry from high to low, and it runs up into that level here, taking out buy side liquidity ahead of Powell speaking, and then down. We have it run back up here, trading into that old high one more time for rejection block, and then sells off aggressively. Rebalances in here, sells off, small little overshoot on this fair value gap, runs right back up into this wick, and then goes to 2 o'clock in the afternoon. Now, 2 o'clock in the afternoon is used anytime we have something that's late in the day. That would be like, for instance, this, the Fed chair speaking, and then we have things like FOMC. So you want to use the 2 o'clock window, and don't just lock it in at 12 New York time. So you'll see me refer to this time of day for specific reasons, and it's all economic calendar based. All right, so let's go over to the British pound. All right, here's the British pound 5-minute chart. Initial low of the day in London open, kill zone. Runs the buy side liquidity pool here. New York session. Small little fair value gap here. Trades down to consequent encroachment there, comes back up, finds some support at this liquidity pool, and then runs it right up into and above March 3rd's daily high. High forming, London close, higher time frame premise, dollar's potentially bullish, so that means it's likely to sell off. It runs into and ahead of Powell speaking. You see that? Whenever you see this type of event, okay, now think about what I was saying last night where I was anticipating the market wanting to just continue, not having deep retracements. Why do I think things like that? Because I'm looking at the economic calendar, I'm looking at the weekly profile of what I anticipate happening, and that means non-farm payroll being a little unexpected, okay? And usually non-farm payroll weeks, you see these sustained type runs, and it goes right into like a PAL event or a FOMC or a non-farm payroll event. And you can see they just lead it all up into and ahead of PAL speaking. And all this is building in a premium. Anyone that's wanting to sell short, they just keep getting crushed. They run out March 3rd's high, and they break it down. Institutional order flow entry drill, right there, breaks down. And again, till 2 o'clock in the afternoon time frame. The low actually forms 5 minutes before 2, and that should be sitting right there. I apologize. So it kind of frames the low out on the day. So these are key times, and it has to do with the economic calendar. If you don't feel comfortable with what I've already said, trust me, I'll talk more about it in other lessons. All right, and I'm going to close this with the S&P. All right, here's the S&P 500 March contract, and we'll be looking, if we look any more at this, we'll be using the June contract because March is going to be expiring soon. So Powell speaking again at 12:05, trades up into this imbalance, and I'll show you what that is. I gave you some ideas about how I use fair value gaps and market structure. If you look at this low over here, okay, see this low makes this swing high, and then finally it breaks down. Remember the discussion I showed you when we were looking at the green lines in the previous discussion, and it was last weekend's commentaries where I talked about it, and I used the imbalance in here, and you extend that out in time, even through all this stuff over here, it's going to respect it because it's all based on this market structure premium. Then it breaks here, used it in here as support and resistance idea, and then comes back into a pump into Powell speaking today at 12. Now I'm going to zoom in here and show you what that, because it's not the 5-minute imbalance. There's your 15-minute time frame. See that little imbalance right there? Buy side imbalance, sell side inefficiency. Carry that through. Sensitivity right there. Bam. Down. Sell side liquidity below here and here, and it really ran for it. I gave you an objective of 37.57 last night in the recording while we were up in here, and I said that we're probably going to see it trade down to that, and well, here you go. If you look at a 4-hour chart, actually use an hourly chart real quick. Let me see if I can see anything here. A little bit of an imbalance there still. That's what this red line is. We could get down to that. But 4-hour, and let's zoom in. Here's that imbalance I mentioned last night, and we went right on through that. Let's take all this off. So we had a nice sell-off in here. But look at the 4-hour imbalance here. Sell side imbalance, buy side inefficiency. We pump up into that ahead and going into Powell. So the Fed Chair Powell speaking at noon today, all this run up into that was what you would expect. Right in here. Now I had your attention down here. Right here at this imbalance. This fair value gap. When price was going up against that directional bias and closing in this gap, and when Powell started talking, I don't care what he's going to say. I don't even know what he said today. I just know that that's likely to drive the volatility into the levels I'm looking for. So you can see what I'm doing. You may not fully understand how I'm doing it, but what I'm doing is I'm balancing the expected volatility using the bias that I've outlined for a while now based on all this movement in here, all the key turning points in here and in this big slide, and then the retracement today, and then reaching into and beyond what I said last night. In truth, what I was looking for was it to trade down to this fair value gap, create the low of the day, and then on non-farm payroll Friday, continue to go into this area here. That's what I was going to call. So I'm going to call that now and say that's what I'm looking for tomorrow, and maybe even a run out of that low if we get, whatever volatility might be there. But just like I showed you on that dollar index, let's go back to the hourly chart and I'll show you something. Now I was looking for 37.57 last night as I called on S&P. And I want you to think about how using the information that I've showed you on the dollar index, where's the swing that I would use for the S&P? Here's that retracement back into that imbalance here, and the market structure is broken. We come back up into that imbalance. All of this right in here. Okay, see those bodies? Right in here. See that? I'm going to take the fib, grab the highest open or close, anchor it, drag it down to the lowest open or close. All right, using the bodies here and that same projection model for what I showed you on the dollar index. So for swing targets, we're measuring the body to body and projecting it down. 37.57 doesn't have a fib level up here lining with it, so the next one you consider it. And then, but it starts to go aggressively lower. So when it does that, I was looking for all this movement here to roll into non-farm payroll Friday and trade down to this level. That's what I was expecting. So I was looking for it to get kind of close to 37.57 for the low of the day, but it ran through it. So whenever that happens, you got to look at the projected market structure swings in here that was not available to me when I talked to you last night. This is in the market doing the same thing I showed you on the dollar index. What's the projected low? 37.20 and a quarter of a point. The lowest of this swing here comes in at 37.20 and a half. So I'm off by a quarter of a point. That's not bad. And then we have that rejection here. So again, while you may not be an S&P trader at heart or even want to take this market on later on, it's just a really, really fun market when you know what you're looking for. Clearly, I've outlined it and showed it to you this week. But if anything ever goes wrong with Forex, I'll go back to this market. It still works. It's still good. And some of you have been really fascinated with what you saw this week. And maybe that's going to be your calling. But don't force it. If it's not in the cards, you'll know. But you need a little bit more money to trade this market, just so you know that. So until I talk to you tomorrow for our daily log entry, be safe.